TFSA and RRSP, such powerful registered accounts to grow your portfolio in. You get to contribute $6,500 for TFSA every single year and 18% of previous year's income for RRSP. And the thing is, I hear people say that they rather invest in riskier growth stocks for these registered accounts because, well, the argument is that you don't get taxed for capital gains. Might as well invest in riskier stocks in the long term to take advantage of that. But see, this is where I don't agree with this strategy. You only get a certain amount to contribute into your TFSA and RRSP every single year. So if you lose your investment, you're done for the year, meaning you can't contribute again for the year. This will really impact the benefits of having a TFSA or RRSP. I'm one of those people that likes to invest in safe, high dividend aristocrats for the long term, especially for registered accounts. This option is definitely a lot safer, and since Canadian dividends are not taxed in registered accounts like TFSA and RRSP, this makes high yielding dividend stocks an attractive option to invest in for your TFSA and RRSP. So today, let's discuss 3 best stocks to invest in for your TFSA and RRSP. Before we start, please remember to subscribe and turn on notifications for my channel. I upload videos on financial tips and financial comedy in my shorts. So if you want to get some financial tips about finance or get a good laugh, your support via a subscribe is always appreciated. Now that we got that out of the way, let's continue. The first stock we'll be discussing is Fortis or FTS. Maybe one of the most reliable companies with a long-term track record in North America. What makes Fortis different from other utility companies is that their main business model is providing regulated utility, meaning that they own the poles, lines, meter boxes, and other means of power generation. They then work with the local governments to work on providing consumer rates that guarantees profit as well as benefiting the consumers as well. Since Fortis owns all of its own assets, the barrier to entry for this industry is very high, making it tough for competitors to take away market share. Fortis is currently sitting at 49 years of consecutive increased dividend payments, which is one of the longest in Canadian history. The company also aims to keep a 70% dividend payout ratio. Throughout history, Fortis has an average net profit margin of over 12%, whereas the average of the utility sector is about 10%. I mean, if you just look at the stock history, the graph just goes up and it's no surprise. The next stock, Bell or BCE. Here's the thing, Canada really doesn't have many telecommunications companies. You have Bell, TELUS, Rogers, and that's it. There's nothing safer than investing in a telecommunications company that's dominating the market in Canada. Bell offers one of the highest dividend yields in Canada at over 6% and has been increasing its dividend yield for the last 14 years. One look at the balance sheet shows that the dividend payout ratio for Bell is over 100%, which is a little bit concerning, but Bell has been investing heavily on 5G technology, blowing through a lot of capital. So I don't see this as being a problem for the long term. Once interest rates begin to fall in the future, who knows when that's going to be, the company can start to ease its expenses, which can ultimately reduce the payout ratio, not the dividend payment, just to be clear. I'm sure they're aiming to become a dividend aristocrat, so I'm pretty sure in the long term they'll be increasing the dividend payments as well. So that's why I believe that Bell is such an excellent stock to buy and hold for the long term. It's certainly good for TFSA and RRSP investing. The last stock I'll be mentioning, Granite REIT. If you don't know what a REIT is, I made a video about it a couple days ago. Feel free to check it out. The Granite REIT primarily invests in North American and European industrial properties, recently focusing more on e-commerce. And with the growth of online shopping and changing shopping habits in general, the demand of warehousing and distribution facilities has skyrocketed. Granite, being so diverse in the European and North American market, is in prime position to grow and expand its market share. Currently, this REIT pays about a 4% monthly dividend, which is pretty solid. I mean, it's about 2 times the average of S&P 500. Overall, the growth potential is there, and its business model in investing in e-commerce as well as gaining market share through acquisitions and development makes this REIT an attractive option to invest in for your TFSA and RRSP accounts. And because these are Canadian REITs paying out Canadian dividends, you don't have to pay tax for these registered accounts. Did this video help you out? If so, please remember to subscribe and turn on notifications for my future videos regarding financial tips on my long form content and financial comedy in my shorts.